Hey everyone, and welcome to This Explainer. Today, we are embarking on a high-stakes financial investigation. We're going to crack open one of the most critical, yet, let's be honest, frequently misunderstood areas of accounting, the balance sheet cycles for long-lived assets, intangibles, and prepaids. So grab your magnifying glass and maybe a really strong cup of coffee, because what we uncover here can literally make or break an organization's financial integrity.
Okay, so I want you to put on your detective hat for a second. When you look at a balance sheet, it usually looks pretty neat and tidy, right? Everything balances. But what is really hiding beneath those top-line numbers? We're on the hunt for the hidden errors, the misclassifications, and those sneaky control gaps that can trigger massive compliance failures, SEC comment letters, and PCAOB deficiencies. Because we're talking about very real dangers here. Things like ghost PP&E. Yeah, assets that have been sold off or scrapped but are somehow still haunting your fixed asset register. Or you might stumble across improper recognition, like internally generated brands just sitting there on the balance sheet when GAAP strictly forbids it. Okay, let's dive into this and see exactly how we can uncover and fix these exact issues.
So here's our game plan for today. We'll cover high-risk balance sheet errors, walk through a 5-step advisory method, figure out who actually owns the asset cycle, look at key metrics and fixes, and finally, apply all of this across different industries. Let's get moving.
All right, stop number 1, high-risk balance sheet errors. We really need to understand what's at stake when the asset cycle goes sideways.
Take a look at this risk register. Notice something? Every single risk listed here, from failing to amortize a finite-lived intangible, to outdated goodwill reporting unit structures, to that ghost PP&E we just mentioned, it's rated high. None of these are minor, sweep-it-under-the-rug kind of findings. Each one carries a direct material effect on the financial statements or your ICFR compliance. Now, as we dig in, there are some massive red flags you need to watch out for on any engagement. I mean, if you see customer relationships classified as indefinite-lived, or R&D costs just sitting there internally capitalized as intangibles, alarm bells should absolutely be ringing. Another huge one to look out for is when indefinite-lived intangibles are just never tested for impairment, or, the test itself simply isn't documented anywhere. But honestly, the biggest red flag might just be this. Listen to this quote. "A business combination where 100% of the purchase price lands in goodwill almost always means the identification work was never done properly." Think about that. If you buy a company and dump the entire purchase price straight into goodwill, you have missed a crucial step. It is absolutely critical to properly identify intangibles during M&A. So how do we actually fix this? That brings us to Section 2, the 5-step advisory method. This is your definitive toolkit for combing through the balance sheet. Think of this as your ultimate diagnostic playbook. Step 1, map assets by type. 2, review that intangible asset register. 3, audit your goodwill impairment. 4, verify those prepaids. And Step 5, test the SOX controls holding it all together. Let's actually zoom in on Step 2 for a second, the Intangible Asset Register, or IAR. This isn't just nice to have, it's a required schedule that must be reconciled to the general ledger. It verifies whether an asset is finite or indefinite and checks the accuracy of your amortization. So the crucial point here is getting that classification documented and supported correctly. Because without it, your amortization periods are just guesswork. And really, Steps 2 and 3, reviewing the IAR and auditing goodwill, that is where you earn your keep. The stuff requires the absolute deepest advisory judgment, and it's where you'll usually uncover the largest errors. You have to verify if an external valuation specialist was actually engaged during a business combination. You've got to rigorously check those discounted cash flow assumptions, like discount rates and revenue growth, and make sure the goodwill reporting unit assignment is actually current. And you really just have to use your common sense here. You have got to watch out for the specific mismatch. High growth assumptions in a declining business. It's a huge red flag in goodwill impairment testing. If the market data and the company's own budget are showing a downturn, but the impairment test projects massive growth just to avoid a write-down, yeah, that is an investigative lead you absolutely must follow. Moving right along to Section 3, who owns the asset cycle? Time to figure out who the usual suspects and witnesses are in the organization. Because ownership here isn't just one person, it's a massive ecosystem. You've got the board approving M&A budgets, the CFO authorizing the capital, but down in the trenches, it's the M&A team identifying those intangibles, And meanwhile, finance is maintaining the register, legal is tracking patent expiry, and external auditors are challenging the whole shebang. It is a highly interconnected web.
All right, Section 4, Key Metrics and Crucial Fixes. Let's look at the actual analytical dashboard and how to cure these balance sheet ailments.
Take a look at this critical KPI, 20% plus. What does that actually mean? Well, you should be tracking the percentage of reporting units that have 20% or more headroom in their goodwill impairment coverage. If you've got reporting units hovering with barely any headroom, you are dangerously close to an impairment charge, and those areas are going to need intense, continuous scrutiny. So, what are the top priorities to keep things clean? First off, engaging valuation specialists for material combinations is non-negotiable. You also absolutely need a firewall between your intangible asset register and your fixed asset register. Lock down your policies on asset lifespans, strictly track R&D to avoid improper capitalization, and tighten up those prepaid schedules. Trust me, the valuation-related items here will prevent the absolute largest financial statement errors.
Oh, and speaking of prepaids, please don't overlook step 4 of our method. Verifying the prepaid schedule is literally the single most common source of year-end audit adjustments. Something totally simple, like an item with an expired service period that's somehow still carrying a balance on the prepaid schedule, happens all the time. It's a massive, frequently overlooked error during the monthly close that always comes back to bite companies at year-end. Okay, we're in the home stretch. Section 5, Applying Methods Across Industries. Let's see how our investigative method adapts to entirely different business models.
And this brilliantly illustrates how flexible those 5 steps really are. Let's compare tech companies with consumer brands. In tech, you're obsessing over capitalized software, tracking development stages, and untangling SaaS versus on-premise models. But jump over to a consumer brand or retail engagement, and boom, the focus completely flips to indefinite-lived trademarks and testing goodwill during market disruptions. Now, what if we compare those consumer brands to healthcare and pharma? In the pharma world, in-process R&D, or IP R&D, is a massive deal. It gets recognized at fair value as indefinite-lived right up until FDA approval or, well, abandonment. Plus, you're tracking incredibly complex FDA milestone accounting and measuring patent life versus actual market exclusivity. The core 5 steps are exactly the same, but the clues you're hunting for change dramatically. Wow, okay, we have covered a ton of ground in this explainer today, from high-risk red flags to the 5-step method and industry fixes. But I want to leave you with one final provocative question to take back to your own organization. Is your intangible asset register telling the whole story? Apply this toolkit, ask the hard questions, and find out what's really hiding on your balance sheet. Thanks for hanging out with me, and keep investigating.